million and as much as $240 million. Let's look at CDW's IPO a little more closely. Documents that CDW's underwriting syndicate prepared said that CDW estimated that it would net about $370 million. CDW did something very smart in those documents. It listed how it planned to use the proceeds. It would use $344.2 million to redeem 2 debt issues and would also pay accrued interest on other securities. Telling investors how you plan to use the proceeds of a security issue is a good idea. That lets them decide whether or not they like the idea and want to participate. That's much better than saying the issue is for general corporate purposes. Hey, a raise and a company car for me are both general corporate purposes, right? But you probably wouldn't want to buy securities if the proceeds will fund my raise and my car. General corporate purposes sounds so much better. Investors have learned not to play those games unless they get a steep discount on the shares. Unless you want to sell your IPO shares at a steep discount, tell the buyers exactly what you'll do with the proceeds. The reports filed shortly after the IPO showed that CDW used 3 lead underwriters, and the names are familiar: Barclays Capital, Goldman Sachs and Company, and JP Morgan Securities. The rest of the underwriting syndicate contains some familiar names too, including Bank of America Merrill Lynch, Morgan Stanley, the German powerhouse Deutsche Bank Securities, and several relatively smaller players, including the Williams Capital Group and Loop Capital Markets. If we kept looking through CDW's reports, we'd see that the transfer agent was American Stock Transfer and Trust Company. A transfer agent records people and institutions that own a company's stocks and bonds. Usually, companies outsource this to a specialist. American Stock Transfer and Trust is one of the major players in this area. Next, we might see several housekeeping items, like the company name, address, phone, and website. We'd learn the share price for sure. For CDW, it was a disappointing $17. Only 23,250,000 shares were offered, and they brought in a disappointing $395,250,000. No current shareholders sold shares as part of CDW's IPO. That's good. Insiders usually know more than others about the value of their company. In general, if insiders are selling, then I'm not buying. Sales by existing shareholders are less important for IPOs than when a public corporation sells additional shares, though. In those offerings, called seasoned equity offerings, the share price tends to fall by more than 3% because the market sees that the current shareholders won out. Usually, letting insiders add their shares to either an IPO or a seasoned offering is an expensive perk. CDW didn't make that mistake. The documents for an IPO also list the number of shares outstanding after the offer and contain 2 bits of industry jargon, the lockup period and the quiet period. Remember the lockup provision? In CDW's case, the shares sold in the pre-offering phase couldn't be resold for a 180-day period that ended on December 24, 2013. The quiet period expired on August 6th, 40 days after the offering. The SEC imposes a quiet period because it thinks companies might try to hype their stock to drive up the price. No promotional publicity allowed. CDW and its underwriting syndicate seem to do most everything right, but the offering still can't be called a smashing success. CDW had to scale back the size of the issue and the offering price. What happened to the share price that day? It closed at $18.37, up about 8% from the offering price. That sounds like a good return for one day, and it is. But remember, just a couple of days earlier, the expected range was from $20 to $23. Settling at $18.37 is a disappointment, especially when we see what happens to the typical IPO